you reduce risk when you're investing your money and still make sure that you gain good returns? Of course, that's the holy grail. You're looking to try and maximize a return, trying to get money being made for yourself, but you want to limit the risk. You want to limit the downside. Everybody does. It's understandable. Let me give you a list of things that you can do. Number one, understand that risk is in everything. You're crossing the road, there's a risk. Wow, of course. Okay, well, depends on the road. Yes. Okay, so exactly the same thing when it comes to investing money. Everything has a risk. Leaving your money in a bank account that's making you zero is a risk. If inflation is 5%, in 14 years, your money's worth 50% of what it is today. So just remember, number one, everything's got a risk. So you've got to appreciate there's a risk to doing everything. You can mitigate it, but doing nothing isn't an option. Number two, just remember, you want to diversify. Easy to say diversification, okay, or maybe it's not easy to say, but people talk about diversification and really it is kind of easy to go diversify. But what does it mean? Well, it means different asset classes. It means a spread of investment. You can have your money in a managed fund, a well-managed fund that's diversified. If you're in an ETF, that's not necessarily diversification. It's diversification of that index. But that index could be dominated by certain companies. For example, if you bought the South Korea ETF, then 40% of it is Samsung. If you go and buy the S&P, there's some big companies there, some big tech companies that dominate it. And of course, the NASDAQ, the same. Big organizations can dominate indexes. So managed funds, when they're managed by good fund managers, then of course they can diversify the money across different asset classes and manage it effectively. You say, I don't know which one. Talk to a financial advisor. Past performance is not necessarily an indication for the future. Although you would say if they're a good fund manager, they're probably going to stay a good fund manager. It isn't always the case. So then you could say, well, then what do I do? Well, you can diversify your managed funds. So for example, if you were to look at managed funds and see that there were 3 or 4 that were very good, then why not spread between 3 or 4 good fund managers? And of course you can, if you wish to, put more in one of those managed funds. Okay, you say, well, isn't that limiting my return? Yes, but we're talking about limiting your downside, reducing your risk. And whilst you may feel that that particular fund manager is absolutely fantastic, then that's great. I would say still diversify. You say, my financial advisor doesn't agree. Okay, well, you decide, because don't forget, so when I'm listening to a financial advisor, it's just an opinion. Everybody's got an opinion. Yes, it's a professional opinion, but nevertheless, you need to have done some research. It's no excuse to say, well, my financial advisor said this. Okay, well, actually, whilst your financial advisor may have said this, that's an indication. They've got knowledge. Always check it out. Always make sure you look and have your own knowledge as well. Personally, my advice, but then guess what? Check it out, is to diversify amongst a group of the top fund managers. Okay, number 3, make sure that when you're looking at your investments, that you realize that your attitude towards risk is vital. I started with number 1 saying there's always a risk. Number 2, you've got to diversify. Number 3, what really is your attitude towards risk? Because people often try and look and think they want zero risk. I've seen many investors where they look for a really, really low risk investment. Okay, and then they invest in something that I think is high risk. Okay, so when you're analyzing risk to investment, what do you really think? What is the potential downside? Does it worry you if something drops by 20%? If so, you shouldn't be investing in the crypto market. Fairly obvious. Got massive upside, but it's volatile. So guess what? If you're losing sleep over it, it's not a good investment for you. And if you still like that market, put 5% of your money in that market, or even 1% of your money in that market. Okay, I follow this for myself. 80% of my money, I just don't want to worry about it. 80% of it, I want it to be steadily giving me a good return. I actually invest in structured notes. We do it as a company, but there's lots of banks that can do that for you. I think we do it better than anybody else, but 80% of it is what I think is low risk. It's there in the background. I've got a 5-year time horizon. It's there. I'm not going to worry about it. I'm not going to think about it. Then I've got 20% of it where, and I'm in the investment industry, where I've got conviction. In other words, I feel like something's happening and therefore I'll invest into it. Okay, as an investor, you may not feel the same way, but it's a good advice to make sure that you've got a percentage just there that you don't have to worry about. Steady investments and diversified. But how do you really feel? Do you want the excitement of it? Okay, well, if you want the excitement of it, still don't put all your money in one area. I promise you, your long-term investment, once money drops, it's hard to catch up again. You want to make sure the bulk of your money is just diversified. But nevertheless, think it through. Ask yourself questions. What's the downside? Could I sleep? Would I be okay? Would I feel good? What's my time horizon? What am I thinking of? How old am I? What do I feel my potential earnings are? Is this massive to me? Okay, and this really mixes with my next point, which is number 5, regular investments are often better. So what do I mean? Well, if you've got a volatile market that's bouncing up and down all the way through, and if you're investing on a regular basis, your average cost is lower than someone investing once. In other words, you can't time the market. It's time in the market. So if you're in the market on a medium-term horizon, you make money. Okay, you don't want to be coming in bang at the top. So if you want to invest and you want to reduce your risk, then put it in on a regular basis. That could be a monthly basis, or it could be that you decide, even if it is a lump sum that you have, that you want to put some now, some later, some later, some later. And what you're trying to do is you're trying to make sure that it's going in on a regular basis so your average cost is lower. It's sensible. Okay, if you're talking about property, fine, invest into it. Again, nothing wrong with that. Just don't put all your money in one area. What does Sod's Law say? If all your money's in property the day before you retire, what do you think's going to happen? Okay, you're absolutely right. It's not just it's gone down, but you can't sell it for love nor money. Okay, always make sure we're back to this same thing, that you're diversifying, and if you're investing, put it in on a regular basis. Okay, next, make sure for me that you've got somebody that is knowledgeable you're talking to. Again, I'm suggesting a financial advisor, but I'm still saying it's just an opinion. But also talk to other people, get their opinions, and be careful about someone that is a so-called expert. In other words, what do I mean? Someone on the internet, there's plenty of them. Some of them love me. I've had all sorts of emails from people saying, wow, your advice is fantastic. And then you get the one or two that I've never spoken to, never given advice to, saying I'm crazy. Okay, yeah, that's true. People have got opinions, but you've got people out there that give opinions that really shouldn't be. Journalists are one, for example. They'll give an opinion. Okay, but actually they're a journalist. And really, if you study their record, previously they were a journalist on something else. Okay, not necessarily a great opinion to go for. Go to Bloomberg, go to the Financial Times. Look at people in the banking industry. What are Goldman Sachs saying? What are De Beers saying? What are Morgan Stanley saying? What are the big companies saying about the overview of the market? Go to Bloomberg, go to the Financial Times, go to people that specialize in financial services. Yes, take different opinions, but take opinions from the right people. No offense to the bus driver, but don't take the opinion of the bus driver. He may not understand the financial markets. Okay, I'm sorry, but that's the way it is. You want to reduce your risk, go to the right places to get the right information. Several opinions, nothing wrong with that. Okay, we do structured notes. What does that mean? Okay, well, they limit your upside, they limit your downside. So in other words, we can do something, for example, in the crypto market, doing something right now where a client's not going to get all the upside, but they can potentially get, let's say, 30% per annum, provided the market doesn't fall by 30 or 40%. Depends on the day. We structure it for a client. They've got a maximum return of 30%, but they've got limited downside. Can do the same on indexes, obviously a lower return, but you can have different types of products. So think managed funds, diversification of assets, structured notes, which can limit the downside on your investments. Okay, most important of all, don't worry. Okay, worry's not going to do you any good. Okay, things need time. So people will say, this happened. Okay, it was too short term. Okay, you can't think of investing as something that is a short-term thing. So it doesn't matter whose opinion it is. Usually it's going to be the wrong person. But if you're investing your money, you need to be thinking 5 to 10 years, preferably more. And then your money compounds. Money makes money. Okay, and that's exciting. So if you've got some good diversification, you're invested in the right way, and you leave it to grow, then you'll make money. Okay, if you invest in something and it's designed to go for 5 to 10 years and you invest for 2 years, then guess what? You're subject to market volatility. So if you're going to invest, then make sure you understand the right way to do it and the wrong way to do it. Okay, if you want to ask me questions, more than welcome. I'm available. Instagram's probably the easiest. Nigel.green. Okay, again, on YouTube. I don't use Facebook. Okay, someone else does it for me. I'm a CEO, busy guy, so lots of things to do. But I try and answer on Instagram. Okay, and I also try and answer, if I can, on my YouTube channel. Okay, trust the information is of use to you. Okay, most important of all was that last point. Don't worry, okay? Just think about it as long term. Get the right investments, let it go. Let it go, relax. Over a period of time, it's proven time and time again that money makes money. Okay, and if you're in the market, and particularly when you're in good funds with good advice, give yourself the time and you'll make good returns for yourself and achieve financial security. And financial security is giving you the choice to do the things that you want to do when you want to do them. Hit subscribe, please like the video, please share the video. Everybody needs advice on mitigating their risk, reducing their risk when it comes to investing money.